Your debt ratio calculation, or your debt to income ratio calculation, as you may hear it called, along with your credit score, are the top two factors in the mortgage underwriting process. Now, these two things really have a lot to do with determining whether you can qualify for a mortgage, and if so, how much you can qualify for. So I wanted to explain the debt ratio, or debt to income ratio calculation, really quickly for you. It's real simple. Let me share my screen with you. And let's just start by saying your monthly income is $5,000. Your salary is $5,000. Now, we all know if your salary is $5,000, you're not actually getting $5,000. You know, some of that money is being deducted in the form of taxes or, insurance. Maybe you have a 401k. So what we're talking about here when we calculate debt to income is your gross monthly income before any deductions. Okay. So let's say in this example, your new mortgage payment is going to turn out to be around $1,200, or it is going to be $1,200. You already have a car payment, let's say, of $400, and you've got some credit cards, so the monthly payments on those total up to be $200. You've got some student loans that are $100 a month. Now, note that even if your student loans are in deferment, the lender still has to count a monthly payment for those student loans. So, and the calculation for that is dependent on which loan program you're using. I won't get into that in this video, but just know there will be a payment included for those student loans unless you're on some kind of an income-based repayment plan where you don't have to make a payment right now. So the total up of all these monthly payments is going to be $1,900. Now, a couple things I would ask you to note here is you don't see anything included in here for insurance payments, utilities, or anything like that. Those things are not included in the debt ratio calculation. Also note that if you are paying, let's say, child support or alimony, those payments do have to be included in the debt ratio calculation. Also, if you happen to own any other real estate that's in your personal name, even if you don't have a mortgage on that, you have to include the property tax and the homeowner's insurance, if there's insurance, or the hazard insurance, in this debt ratio calculation. So just note those two things as well. All right, so we've got $1,900 in monthly payments. We've got a $5,000 monthly gross income. You divide the $5,000 by $1,900, and that gives us a debt ratio of 38%. Now, depending on your credit score and which loan program you're using, which 38% is right in line with where the debt ratio needs to be. But you may have heard me mention in some of my other videos, if you've got a really high credit score, on most all of the loan programs, you're going to get more leeway on that debt to income ratio. So that's how we calculate, or that's how lenders calculate debt to income ratio. I hope this is helpful to you. If you have specific questions on qualifying for a mortgage or anything about the mortgage process, please feel free to reach out. My contact information is on the channel homepage. I'll be glad to help you in any way I can. Thanks for watching. We'll see you soon.